At Summerfest Tech 2025 in Milwaukee, Andreas Bubenzer-Paim, Head Technology Banking, BMO Commercial Bank, moderated a discussion with leaders from all three corners of the capital ecosystem, startup, venture capital, commercial banking, who shared their insights. Take a listen.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
My name is Andreas Bubenzer-Paim. I run technology banking for BMO's Commercial Bank. I'm joined today by three awesome panelists: Darren Webb, CEO of Mindset; Priscilla Guevara, partner at Science BC; and Derek Garland, my colleague at BMO, who runs our Business Transition Advisory Group. So let's dive right in. Access to capital at every stage of growth is kind of like what I want to kick it off with. As my first question goes to Darren, how did you raise your first round? Can you share this story?
Yeah, obviously so lucky to partner with Science here. We raised our pre-seed round led by Science. It was a $250,000 check, and this was pre-product, pre-idea. And it was actually something different I was working on. We were building a social network for mental illness caregivers. And my brother, who is kind of the genesis and the reason why I started Mindset, was just released from incarceration. Kind of went through that experience of trying helping with disability benefits. And I went back to Science 3 weeks later and said, hey, what you guys invested in, I'm not doing that anymore. Work on this next problem. And to have investors that, were so malleable and excited to help push this new idea forward is very special. You don't find that often. So I'd say over a 9-month period, it went from a $250,000 check to, multiple millions that Science put in and helped us scale. During that period, didn't work with any other investors. Working with a fund like Science, I'd scope with one of their general partners 3 times a week for a year, just on everything that was going on in the business, getting very granular and, packaging this product up and getting ready to go out to, new investors.
Can you go a little bit deeper in terms of, you mentioned you only work with basically Priscilla, right? When you kicked off the company, bootstrap, did you do some like family and friends? See, like at which point did you decide you're going to go the VC route? And did you only talk to Science, or did you talk others to, like, how did you ultimately decide to go with Science? Like, what was that process like?
Serendipity. I was at an event in New York City during Crypto Week. One of Science's partners, Peter Pham, I saw him in the Milwaukee area. I went to go pitch him, but I couldn't get through. So marketing worker, I gave the bouncer $100 and he let me through. And I went and introduced myself to Peter and I said, hey, I want to, pitch you on this idea. He showed me his phone and he said, my Uber's going to be here in a minute. You have 60 seconds. So we're walking out. I pitch him. He said, I like it. He introduced me to Priscilla and others. And 2 weeks later, the term sheet was delivered.
Amazing. So Priscilla, on your end, you must have done something right as well to press them so much. What made it appealing for you?
Sure. So there's a few things just to give you a sense of Science's model. We're not a typical VC. We're what's called a studio fund, where we partner with founders, generally mission-driven founders, and we partner with them as lifecycle investors. So we're helping with them as their co-founder. We're helping to build the business. We're helping to scale them, and then ultimately help them find the exit track they're looking for. With Mindset Care and with Darren specifically, we were looking for a mental health platform to partner with. We didn't know what that was going to look like. Similar with when we were looking for a CPG company, we didn't know that we were looking for water. And in this case of water, we didn't know that it would eat liquid death. Same thing for Mindset Care. One thing that stood out to us was Darren and his connection to his personal story with his brother. And we knew he would make that difference and that impact across the world. So for us, when we're thinking about how can we make a bigger impact in not only just our portfolio, but also the broader world. And so for us, thinking about a tool that would help to provide Social Security and disability benefits to help legacy systems be a lot more efficient. That's one piece. But I mean, thinking about Darren specifically as a founder and what he brought to the table was something that we valued. As Darren mentioned, we spent months with him and his team and ideating and seeing that evolvement and just how dedicated he was to this mission was profound. So for us, we saw something in Darren and we really wanted to partner with him, and we knew he's going to be super successful in this. And along the journey, it's been great. So we've been able to find so many partners yeah, we're very fortunate to partner. So we're very lucky.
And there, just quickly back to you, quick follow-up to my earlier question. So, yes, you got money from science, right? But I assume it was so much more. Can you talk a little bit about the so much more part, like that makes it a real partnership?
Early calls, late night calls, hiring, starting off, I was the head of HR, head of marketing, head of sales, head of everything. Being able to delegate some of that to a partner in a VC fund is really special. Having multiple partners that I can call on at any time to ask questions. They all have different strengths, which allows us to tap into that knowledge. So I just think you can't find that everywhere. And I can say that now in retrospect, having, multiple VCs as partners and on our cap table, science still is that one firm that, HR helped hire and firing, user acquisition, wherever it may be, even, setting up our Facebook ads to get that granular. They've got an entire team prepared to, as Priscilla said, be your third co-founder.
That's amazing. Moving on, strategic considerations. There, your time has come. So as businesses grow, what's your perspective on strategic considerations they should have? And what are the things they should be thinking about?
Yeah, it's a great question, and it's a broad question. One of the things that I think we see from our seat is that there's increasing competition in the industry as far as identifying really great companies earlier in the process. And so I think when we think about strategic considerations, we like to work with founders to help them understand, again, what the universe looks like and how can they quickly get into a state of structure. And so thinking about governance, thinking about defining roles within the board, within the business, and understanding how responsibilities lie. Darren just hit on a big point that we talk about, which is getting really comfortable with delegation. And so understanding as a founder where your value truly lies at as far as your strategic vision for this company and where you can rely on other resources. And all at the same time, thinking about yourself personally to say, I have a great idea and a great concept, and I want to grow and scale this. But at the same time, I need to be thinking about the considerations for myself as an individual. And so understanding just having some base level of a financial plan, right? And so understanding how am I going to live and survive and thrive as I'm growing this business, but also as I'm preparing for an exit. No founder is doing this for nothing. How do I actually prepare today so that I have a really tax efficient exit? So thinking about, it can seem really early in the process, but how do I leverage trust? How do I think about, possibly leveraging something like qualified small business stock and to have a tax exclusion at that exit, and ultimately saying all of this value that I'm creating in this entity for various stakeholders, I want that to translate into something that's not just financial and last past this. And then the final kind of piece of it that we challenge people to say is, again, we can be in a very busy environment today, but let's think about next steps, right? Let's actually have a framework for, as the business evolves, you as individual have to evolve, and you need to be a step ahead of the game here. And so ultimately leaning on your advisory team to really stretch yourself to say, founders can be really involved in the business. They can leverage great VC partners, leverage their board, but also leverage your advisory team to bring advice around tax, around personal planning, around what the environment looks like, so that they're really getting advice from all angles to have a tax efficient exit when that time comes.
Yeah, when we connected before the session, I think you explained really well to me and to us, I think, how setting up the business in the right way, structuring it in the right way can make such a huge difference when then exit or a taxable moment comes, right? So really interesting topic. That's something else that I believe you didn't touch on yet, which I had heard from you before, which I think is good for the audience to hear as well. We were talking about hiring, right? Like different forms of compensation you can use, especially when you're in more of a cash burning stage. Can't really throw, buckets of money at people. There's some other options that are out there. Could you maybe spend a minute on that?
Yeah. I think as we think about, oftentimes you're scaling, you've received a certain amount of capital and you're thinking to yourself, I need to bring on talent. I need to be able to recruit away from competitors in a really efficient way. And one of the things that we're often trying to kind of bring to the table is an understanding of how could we use equity compensation or equity-like compensation to preserve cash and capital on the balance sheet, but ultimately align the interest of, some bigger hires that you maybe can't afford just on a cash basis. And, the typical understanding might be stock options, right? And so giving it an ability again for some folks to buy, stock at a really attractive valuation if the company is growing. But we even use some more complicated structures, and the stock appreciation rights, would be a version of it to say, come into the company as we continue to create value, and as you continue to create value, you can have a compensation element tied to that increase of value. And the benefit there, again, maintaining capital today, but also aligning the interest to say, I want to hire you and for you to be very comfortable. I want you to be just as hungry as somebody like Darren is, right? To continue to create value, and not just paper value that's 12 months on a P&L, value that we can see year over year. And so it's a really great time as you're scaling and growing to be thinking about some more of the sophisticated structures that, again, create that ownership mindset. And again, allow you really efficiently use your capital as you're scaled.
That's awesome. This just another structuring element, right? It doesn't really cost you money to do this, but like sets you up for much more success further down the road. So awesome. Thank you for sharing that. But sticking to that kind of theme, different topic, but a similar theme. There are more cash burning companies, like not having like millions and millions to spend. How do you optimize cash flow and capital efficiency, right? So Darren, how did you deal with this challenge? And do you have some best practices you can share with the audience?
I'm living through it right now, actively. I am not a CFO and our fractional CFO. This is someone that I found, early on, having a partner, my partner Keon last year, former BC that, has access to the books and is able to, help forecast. I think the best thing that I've done from muscle memory is every month I spend 2 days reforecasting, based on revenue that came in the previous month, based on the amount of leads that have come in. We know what that's going to equal in the future. And, there was a time where when we raised our A round last year, you got a lot of money in the bank. And, the first thing to potentially do is you go hire. And that's one thing that I did. I think we added 40 new teammates in a 2 to 3 month span. It was, really fast growth. But there comes to a point where, one of my VC partners said, what are you doing? Right. We got, we can't burn too much. And I think that's something that I'm continuing to learn, really understanding how much you can get out of each individual on your team without having to go and continuing to hire. And that's just the name of the game. Me personally, we are in a space where we don't get compensated for a very long time from the government. So just the business model is the entire thing of forecasting. So
Priscilla, same question for you that I asked Darren, just to get your perspective. When you look at it as an investor, we got your perspective just now. How did you look at it? We don't know if you have specific what Darren's company, but like in general, how do you look at these kind of scenarios?
Yeah, going back to our model, right? We're a venture studio fund. And what that means is we have an entire team of 10 portfolio operators that are helping to essentially go around the table with the founders to be more efficient with that capital for that reason. Additionally, we're coming into companies where they're valued generally 3.5 to 5 million pre-money, and our investment is generally up to $1 million. One thing that's key, though, is that we're not investing that $1 million on day one. As Darren mentioned, we were working with him for months before we developed. He has access to our entire team, our partnership. We then tranche the investment. So we say, here's $250K. And let's get as far as we can. And the reason for that is instilling, there's a philosophy, right, and psychology around how can we be more efficient with our capital and our resources. That's step one. Once we do make that investment and once we can move quite quickly, once we have high conviction. And secondly, we're also then fundraising around the company on their behalf. And we're finding those strategic partners. So when we're thinking about Darren's first round, we found Enable Ventures, which is focused around disability. That was strategic to him. We found Wellington as well. And then as we're thinking in this next level and this next inflection point of Darren's business, I was fortunate to meet Aaron last year here in Wisconsin and found that BMO actually has access to so many different capabilities. And I think as Darren's scaling, one of the things we started to realize was, as Darren mentioned, there's a government payback period, something that capital alone and equity is not going to solve for. And then secondly, as we're thinking about just the future of the customers that are going to receive the benefits, oftentimes they don't have bank accounts. So how can we find a financial partner that can actually help fund bank accounts on their behalf? So it's full cycle. And again, it's, as you were mentioning, Andreas, like everything is so unique to a company. Every company has their own issues and problems to solve for and challenges. And so it's finding those right strategic partners to help fill those gaps. And again, finding that army around the table that can help them get to their point quickly.
Thank you. That's helpful. So we talk about how to raise that first round, strategic considerations, how to optimize like for cash burn, cash flow. But so your company's growing, you get to the point where you at least need to start thinking about an exit. I'm not saying your company, somebody's company, right? So let's talk a little bit about exit strategies. And there, going back, you hinted a little bit earlier in your comments, but so what would you say is the right stage to engage a bank to support with an exit strategy? And from your seat, what specifically can the bank do?
It's a great question. And I think one of the things that might be a little kind of contradictory to expectation is the bank actually likes to be involved very early in the process, because a lot about, when we think about an exit is really based on, again, what that founder is looking to achieve. And that's, on a grand scale of things. And so, what the company might achieve, but again, what that founder actually wants to achieve is a big piece of that process. And so engaging, somebody early from a financial partner perspective can add a lot of value, because it's a competitive environment. And ultimately, really great banking partners want to be able to leverage advice, which doesn't really cost the bank a ton of money, but advice can be really critical in the difference between an exit that's, good versus great. And ultimately, great is what we're seeking to achieve, for the founders that we work with. From a consideration perspective, we oftentimes are working with founders just, number one, on education, right? And so not only what we would kind of call exit options, but something we kind of call strategic alternatives. So as the business is actually growing and reaching a point of being profitable, and a founder might be adjusting their lifestyle a little bit now that they kind of hit a point of traction. So thinking about, are the ways to access liquidity for that founder personally to kind of take some of the pressure off of them and ultimately strengthen their personal balance sheet as this continues to grow. But ultimately understanding all of the different options. I definitely get it. Most people will come and say, hey, I want an IPO to happen. And that's fantastic if that's the pathway. But there are a lot of different exit options at the end of the day. And so very well could be an IPO, could be some type of investment for private equity, a strategic coming in for a merger, or it could, we've actually had founders who really scale the business and said, I've got a great management team and we're all aligned for a different purpose. And we want to then leverage a management team would take over, and then that founder may want to actually go into their next entrepreneurial kind of business and start to scale again, from a serial entrepreneurship perspective.
Priscilla, we know you work with Mindset, but you also have other portfolio companies, as you mentioned. So looking at this bigger picture, your broader portfolio, what's your perspective and how are you dealing with the current environment?
Very good question. In April, we had the conversation around tariffs. Unfortunately for us, we have consumer packaged goods companies. The only issue and impact there that we're seeing is really around the raw materials. For example, for liquid duck, we'd see that for cans. In terms of I would say the current administration, it actually seems quite favorable towards VC and innovation and AI and tech. So on the positives outlook, I'm very excited about what can come for technology and innovation. And as Darren said, maybe there are ways that we can make things a lot more efficient. I'd say on the flip side, it does cause us to be a lot more cautious. And I think for our model, we are not looking to push things just to exit. We are trying to be patient. We have patient capital. And what that means is, how can we use the resources that we have internally to help fund the companies, help get them the resources that they need, and help them stay afloat. Again, if these times are uncertain, we're not seeing exits, as you mentioned, happen as frequently as we want, and that has ripple effects across fundraisers, not only for our portfolio companies, but for funds and just broadly across the entire market. So for us, we want to find the right people around the table to help support our companies.
And maybe quickly adding to that from a banking perspective. So when the new administration came in, everybody thought deregulation is going to drive M&A volume. It's going to be a very active year for the market. And then the whole tariff situation evolved and the market's almost ground to a halt. But they've really recovered since then. Whatever your take is on why, but the markets are very open. M&A is happening, just at lower valuations maybe, to your point, Priscilla, but it's happening. Access to capital is out there, so the markets are there for people if they need that. But one thing I will say, volatility is out there. Actually, some financial products that's actually beneficial for the publicly listed clients and have convertible bonds. The more volatility there is in the stock price, the better terms they can actually get on the bond when they issue it. So sometimes there are some settings where the volatility is actually a good thing, right? I think having a credit facility in place with your bank sufficiently sized to give you some wiggle room, and that feeling of safety is worth something, I'd say. And then also foreign exchange risk, interest rate risk. What's the Fed going to do? But Derek, do you have anything to add from your perspective?
Yeah, I would just say quickly, to support both of these points, oftentimes when we're working with founders sort of either in advance of if they've had, that VC investment, ultimately it typically pays off to be the diamond in the rough in any environment. And so the earlier you can have structure, that you can have strategy, that you can have your story in place, have all of your sort of legal aspects wrapped up, the easier it is when you present yourself, to a potential investor. And ultimately that structure can carry a long way as you think about in an M&A market where the volumes might be down a little bit, the valuations might be down. But again, everybody is seeking that diamond in the rough. They're seeking that differentiated example of, I have good governance, I have a great legal structure, I have this management team around the table, and that's what allows you to be able to pull that lever when others can't pull that lever. So I encourage everybody, again, to make sure that they have that really well-rounded advisory team. And even when you're thinking it might be really early to think about all this structure and organization, it can pay real dividends as the environment evolves.
Thank you.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.